Welcome to Taking Stock for the week ending the 15th of August 2025. I'm Kentrin, Head of Research at Stock Doctor, and joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share market. Welcome, Matt. How are you today?
Very good, Ken. We're in full swing in reporting period, so it's been quite busy, but it's great to be joining you again.
Great to have you on board, Matt, but it's only going to get more intense next week. So look forward to that one. But as always, the information we share today is of a generic nature and doesn't take into consideration your personal situation. Remember, shares are volatile, so any past performance figures aren't a reliable indicator of future performance. Well, reporting season has kicked off on a positive note, Matt. Many companies are either meeting or beating expectations, and the market response has been broadly constructive. In fact, the market here has hit new highs, and investors appear to be taking a more optimistic view into financial year 26, with earnings growth expectations across the industrial space forecasting to rise to around 7%.
Yeah, it's very much risk on, isn't it, Ken? And across several updates so far, we've seen businesses benefit from margin recovery and cost control, particularly those with exposure to the US. Some early results are also pointing to a healthy Australian consumer and improving conditions in housing. Names like Nick Scali popped after their result following a trading update which detailed strong order momentum, whilst REA Group posted another rock-solid result in a challenging listings environment, with investors really encouraged by their terrific margin control amidst the prospects for a positive swing in housing demand as the RBA continues its monetary easing cycle.
Yeah, REA certainly defied the risks there and come out with some positive results. But another theme I noticed was this AI adoption, which came through, especially across efficiency in operations and enhancing customer engagement as well, with many companies reporting or building AI into their strategic priorities, including some of the banks and companies like REA, as you mentioned, Matt, and also Telstra.
And on the macro front, the outlook is a little bit more divided. The RBA, as we spoke about, did deliver its third rate cut this year, bringing the cash rate down to 3.6%. While that's supportive for growth, analysts are questioning how realistic the central bank's inflation targets are, especially with weak productivity, high wage growth, and tight housing supply, putting pressures on housing prices.
Yeah, Matt, and with the employment rates also quite strong, some now expect only one more rate cut this year, with the RBA possibly pausing after November. But the market is still pricing in the soft landing, and there's growing sense that we may not get as many cuts as once hoped. But that's something investors will need to consider as we head deeper into this reporting season. Let's now turn our attention to some star stock highlights for the week.
Yeah, let's start with Treasury Wine Estates, the company behind Penfolds and DAOU. Their full year result showed strong growth in premium wines, which now account for over 80% of earnings. Profit margins did improve, and they announced a $200 million buyback. Return on equity currently sits at about 10%, and net margins are at 15%, although earnings expectations have eased to 8% in recent months.
Yeah, those revisions are down on 8%, but it looks like it's due to some of the cracks that appeared just recently. You had demand for ultra premium wines in China that softened around mid-year. And in the United States, a distributor change in California also had to reset the shipments lower as well. And this could cut around $50 million in revenue for the next financial year. Still, management sees this as a short-term cost that will help them expand their luxury positioning for the longer term.
And next up, Austin Engineering, the mining equipment group. This week, they did revise their previous year's numbers due to an accounting mistake in Chile. Some contracts were counted too early, so this year's guidance is being upgraded, but it's more a timing issue than a signal of deeper problems. But it did raise eyebrows around financial controls.
Yeah, and share price certainly was quite volatile, and that's courtesy of how illiquid the stock relative to our other star stocks are. But financially, Austin is reporting a strong set of numbers with return on equity expected to only decline to around 19%. Note, however, that analysts have cut their earnings forecast by around 15%, although only two analysts follow this stock. So there is a degree of uncertainty here. However, management did say that the cash flow hasn't been impacted, but the market will want some reassurance that tighter checks are now in place.
On to some better news, Can, and Star stocks continue to perform pretty well over the reporting period, with Pro Medicus, the medical imaging software company, rallying another 6% after releasing yet another outstanding financial result. What a company it is, isn't it, Can? While no specific forecast was given for the year ahead, management spoke of a strong contract pipeline as always and hinted that margins could rise even further. This further reinforces the company's solid outlook and high return on equity at over 50%.
Yeah, such an incredible set of numbers, Matt. And over the week, though, there were many more star stocks releasing their results, including Telstra, Suncorp, and Computershare. So ensure you refer to our commentary for further information. But next week will be even bigger with names like CSL, Challenger, BHP, Woodside, Breville Group, and APA. So for full details, please refer to our corporate calendar. This week, under the microscope, we're taking a closer look at retail banking giant Commonwealth Bank. The code is CBA. Its financial year 25 numbers were broadly in line with expectations, with solid operational performance across the board. Yet, interestingly, the stock came under pressure, falling around 5% on the day of the announcement.
Yeah, that's right, Ken. It's unusual to see CBA under pressure, but they did deliver a 4% rise in cash earnings, which was supported by resilient income growth and really good cost discipline. One of the more notable outcomes was the stability in its net interest margins. And if we recall that that's the difference between income from its loans and deposits, which held firm at about 2.08%, despite increased competition for deposits and a softening rate environment. This was a strong result compared to its peers.
Yeah, quite a good result there, Matt. But with interest rates now falling, that net interest margin advantage could start to unwind. You've got lower rates, and that means lower returns on deposit balances. And CBA, they will face pressure to keep lending rates competitive. So while the margin performance was impressive this year, it's unlikely to be repeated in financial year 26, with earnings growth now expected to be in the low single digits.
And as is always the case with the banking stocks, credit quality was another key area of focus. And despite macro headwinds, bad debts remain quite benign, with loan impairment expenses at around 0.1% of gross loans and acceptances. That's well below historical averages and signals a healthy consumer environment. But there are risks ahead, particularly if unemployment rises or housing stress increases as mortgages roll off fixed rates.
Yeah, but that return on equity, Matt, sits at around 13.3%, the highest among the major banks, and a clear sign of strong profitability. CBA also increased its final dividend to 4.85 per share, taking the full year payout ratio to 80%. Quite attractive for income-focused investors.
So you might be wondering what's behind the market's negative reaction, and the biggest factor is valuation. CBA continues to trade at a significant premium to fair value at about 27 times forward earnings, and that versus its peers at around 14 to 16 times. So while its operational strength and low risk profile warrant a premium, it leaves the stock a little sensitive to news and market volatility, as was the case when it released its result. So Ken, what should investors do from here?
Well, that's a good question, Matt. What you do really depends on your investment objective and how long you've actually held on CBA, and also how much exposure you have in your portfolio. If you've held it for years, for instance, your effective yield on the cost base could be substantially higher, and it may make sense to continue holding for that income. But from a risk management perspective, if the position size has grown too large within your portfolio, it's worth considering taking some profits to maintain that diversification, lock in some gains, and also limit downside exposure due to increasing volatility if that occurs.
Correct, Ken. And look, on the back of a pretty solid result here, CBA does remain a star income stock, backed by reliable dividends, excellent capital strength, and industry-leading returns. But with softer earnings growth ahead and margin headwinds likely to build, investors should set more modest return expectations moving forward.
Now for question of the week. The question is, should I sell a stock from my portfolio before they release their results?
Yeah, it's a good question, Ken, and one we do hear a lot during and before reporting period. The answer really does depend on the type of stock you're holding and your underlying investment strategy. If the company is financially unhealthy or highly speculative, and has low levels of liquidity, then yes, it might be wise to exit before results. These type of businesses carry elevated risks of disappointing the market, and the downside can be significant if the result does fall short.
And another scenario, Matt, is when a stock has rallied hard into its results, often without a material change in the fundamentals. That typically signals high expectations. These high expectations are priced in, and in those cases, even a decent result can lead to a pullback, as we've seen, say, for instance, with Commonwealth Bank. So it might be prudent to take some profits off the table and reduce your exposure here.
But before making the decision, it's worth assessing the likelihood of a positive surprise. You can do this by looking at the trend in its earnings revisions, the level of short interest, recent trading updates, and how similar companies in the sector have performed. If peer companies have already reported weak numbers, that could be a warning sign.
With that said, Matt, predicting short-term outcomes is notoriously difficult. Rather than trying to time every result, the better strategy is to think in terms of portfolio risk management. Focus on what you can control. Ensure you're diversified and that the business in your portfolio are financially strong, they have high competitive advantages, and are capable of weathering volatility.
And finally, consider your time horizon. If you're a long-term investor and the stock remains high quality, a short-term dip may not matter all that much in the bigger picture. But if the stock no longer aligns with your investment goals or has grown too large in your portfolio, that may be a good time to rebalance.
Yeah, wise words there, Matt. And in short, don't react out of fear. Instead, be proactive in managing your portfolio risk. That's all we have time for this week. And again, thanks for your insights, Matt.
Not a worry at all. And don't forget to tune in to our Lincoln Live webinar on Monday if you have any questions regarding the results from this reporting period.
And if you're looking for broader financial services, including wealth management, portfolio administration, accounting, or even access to alternative investments, we'll be more than happy to assist. Simply head to the Prime portal within the Stock Doctor platform to explore how our team can support your wider financial needs. Until then, as reporting season gains more momentum next week, it's a timely reminder to stay disciplined, review your holdings carefully, manage risk thoughtfully, and avoid speculation. Wishing you a happy, healthy, and prosperous week ahead.